What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered.
What's up, everybody? Welcome back to another episode of the CPA Zone. I'm your host, Ryan Pulis. I'm a CPA, business owner, and real estate investor. Today, we're going to dive into a topic that comes up a lot when you're selling investment property or even selling a business, especially in this higher interest rate environment. I'm talking about seller financing, and more specifically, what we're going to get into the tax implications of seller financing, and we'll even go through an example of when you sell a piece of real estate. So if you're thinking about selling a property and carrying paper, becoming the bank, or you've already done this and you want to hear some more about it, make sure you stick around because there's some strategy here that might save you a little bit of money. So let's break it down. What exactly is seller financing? Well, it's pretty simple. Instead of the buyer going out and getting a traditional loan from a bank when they buy your property, you, the seller, act as the lender. So maybe you get a down payment from the buyer and then they're going to make payments to you over time with interest. So why would people do this? Well, there's a few reasons. Maybe the buyer can't qualify for traditional bank financing. Or perhaps the seller just wants to have a steady stream of income. And then there's also tax reasons where this can make sense. Because when you finance the sale yourself, the tax bill can play out very differently than if you just sold the property for cash. So first, let's talk about how that taxable gain is recognized. So normally, when you sell an investment property or any asset, you pay tax on the gain. So it's the sales price minus your adjusted basis in the property. Pretty straightforward. But without seller financing, the entire gain is recognized in the year in sale. That's typically how it's handled. Seller financing allows you to spread that gain and tax liability out over a number of years. So for tax purposes, this is called the installment sale method. So when you carry the financing, meaning you receive payments over time, the IRS lets you use this, something called the installment sale method. So here's how it works. You're only going to pay tax as you receive payments. It's a proportional approach. So every time you receive a payment, it's made up of one, a return of basis, which is tax-free, and your capital gain, that's the taxable portion, plus some interest income. And your interest is also taxable, taxed as ordinary income. So let's look at a brief example. So let's say you sell a rental property for $500,000. Your basis, that's what you originally paid, plus any improvements you made, minus depreciation taken. Let's say in this example, that's $300,000. So your gain would be $200,000. Now, let's say the buyer gives you a $100,000 down payment and agrees to pay the rest, the other remaining $400,000 over 10 years with interest. With seller financing, you can use the installment method, so the $200,000 gain is spread out over the years. In this case, you're going to need to calculate your gross profit. So your gross profit percentage, and that's calculated by taking the total gain, so $200,000 divided by your sales price, in this case, $500,000. So $200,000 divided by $500,000 is 40%. So every principal payment you receive, 40% is considered part of the taxable gain. You're going to pay tax on that. The rest is either a return of basis, which is not taxable, or interest income, so the interest portion, which is taxed at ordinary income tax rates. So on that $100,000 down payment you received in year one, 40% is going to be taxable. That's much better than paying tax on the full $200,000 gain, right? Now, there are a few little traps to be aware of when it comes to the installment method. So one, depreciation recapture. So this is taxed in the year of sale no matter what. We didn't go through this in our example just to keep things simple and explain the concept of the gross profit percentage and how the tax plays out. But any depreciation you've taken, that's taxed in year one, no matter when the payments are received. And your interest income, which was mentioned, is taxed as ordinary income. So if you're in top tax brackets, you're going to get hit pretty hard on the interest. But if you're spreading payments out over time, your interest is compensation for taking that risk. Another thing to be careful of is related party sales. So if you're selling to a relative or maybe a business you control, pay attention to the rules surrounding the related party sales because the IRS is pretty strict here and you want to be careful, make sure everything's properly documented so you don't run into issues. And even under an installment sale, there are things that can accelerate that tax. So maybe the buyer refinances and pays you off early. You sell the note to someone else that you're going to pay tax on that remaining gain if either of those scenarios play out. So just plan ahead for it. So why go through all this and use this installment method? Well, you get to defer the tax payments over time. You're spreading out your gain. You could plan this accordingly and plan for lower tax years, perhaps make some of those capital gains tax at 0%. And it's going to depend on your income level and your personal tax situation. But you can use this strategy to help spread your tax liability out and hopefully keep yourself in lower tax brackets in some years. And you're creating a stream of passive income and possibly getting a higher price from a buyer that needs flexible financing terms, so that can't get a loan at a bank. So it could really be a win-win if you structure it correctly. Just make sure you've got all your paperwork's in order, you have a good promissory note in place, and you make sure you're covering all your bases there. So now we can wrap up. Seller financing really can be a powerful tax strategy, especially for investors who want to reduce the upfront tax burden and create an ongoing income stream. But like anything with taxes, the devil's in the details. So if you're considering seller financing or already have a deal in place, make sure you're talking to your tax professional fairly often and plan the deal before you sign the papers, not after. That about does it for today. If you found value in this episode, hit that like and subscribe button. Leave us a review and share the episode with other investors. Until next time, have a great day.
Are you interested in becoming a client? Click the Discovery Meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.